You've probably heard the term market cap thrown around, right? It sounds kind of technical, but what if I told you it's one of the simplest, yet most powerful ideas in all of investing? Seriously, getting this one concept can completely change the way you look at the stock market. So let's just jump right in with the puzzle. You've got two companies. One has a stock that trades for $500 a share, and the other just $5. So which company is bigger? I mean, logic tells you to pick the $500 one, right? Well, in the world of investing, the most obvious answer is very often the wrong one.
And that's because so many of us fall into this trap. We have this illusion that a high stock price automatically means a big, valuable company. But the truth is, the price tag on a single share, it really doesn't tell you the whole story. In fact, it can be incredibly misleading.
Yeah, this is what we call the price illusion. And we need to just completely break down this myth if we're going to understand how the market actually figures out what a company is worth. You see, the real measure of a company's size is its market capitalization, or market cap for short. So what is it? Well, put simply, it's the grand total value of all of a company's shares added together. This one number tells you what the entire market, everyone, thinks that company is worth at this very moment. And the formula to figure it out? It honestly couldn't be easier. You just take the current stock price and multiply it by the total number of shares that exist. So let's say a company's stock is trading at $10 and it has 1 million shares out there. Its market cap is a nice, clean $10 million. Simple as that. And that's why market cap is so incredibly important. It's the great equalizer. It lets you accurately compare the true size of different companies, cutting right through all the noise of those confusing share prices. But here's where it gets really interesting. Market cap does more than just tell you a company's size. It helps us sort companies into different categories, and those categories tell us a whole lot about how they might behave as an investment. We can basically break them down into three main buckets. You've got your large caps, which are typically more stable and lower risk. Then you have mid caps, which offer a bit more of a balance. And finally, small caps, which come with some huge potential, but, you guessed it, also higher risk. So first up, large caps. Think of these as the giants of the market. We're talking household names, companies worth billions, like an Apple or a Microsoft. They're usually pretty stable because they're well established, they have a lot of different ways of making money, and they can handle economic downturns. But what's the trade-off? Well, because they're already so massive, their days of crazy, explosive growth are probably in the past. Then you've got the mid-caps, which I like to call the in-betweens. They're right in that sweet spot. They're established enough to have some real stability, but they still have plenty of room to grow. For a lot of people, these offer a great balance of risk and reward because they're big enough to compete with the giants, but still small enough to be nimble. And finally, we have the small caps. These are the up-and-coming challengers. They're usually smaller, maybe companies you've never even heard of, but they have the potential for absolutely explosive growth. Of course, that potential comes with a ton of risk. Why? Because they might depend on just one product or some unproven new tech. They can skyrocket, but man, they can also crash and burn. Okay, so understanding these different categories isn't just about crunching numbers. It's about really getting a feel for how these different size companies act out there in the real world, in the market. You know, here's my favorite way to think about it. A large cap company is like a giant cargo ship. It's incredibly stable, right? It can weather just about any storm. But it's also really slow to turn, and it takes forever to speed up. A small cap, though, that's a speedboat. It's agile, it can move incredibly fast, but it can also get violently tossed around by even the smallest waves. So you have to ask yourself, what kind of ride are you really looking for? Are you the type who prefers the slow, steady journey of that big ship? Or are you looking for the thrilling, high-speed, and maybe a little scary ride of the speedboat? Your answer to that says a whole lot about your personal tolerance for risk. And this brings us to a classic mistake a lot of new investors make. They just load up their entire portfolio with those high-flying speedboats, thinking it's some kind of shortcut to getting rich quick. And yeah, the potential's tempting, but that ride can be incredibly volatile and really, really risky. That's why a much smarter approach is often to build a balanced fleet. You combine different market caps. You get a few of those large cap ships for stability, maybe some mid caps for that steady growth, and then you can add a few small cap speedboats to chase those high growth opportunities. So let's take this whole ships versus speedboats idea one step further. How can we actually use this concept to make smarter, more informed decisions when we're investing our money? Well, one absolutely crucial thing to remember is that a company's market cap isn't set in stone. It's a living, breathing number. As that stock price moves up or down every single second of the trading day, the market cap changes right along with it. It's constantly updating to reflect what the market thinks that company is worth. So, with all that in mind, the next time you're looking at a stock, the first and most important question you should ask yourself isn't the one that probably pops into your head first. It is not, what's the price? Because now we know that looking at the price alone is like trying to solve a puzzle with only one piece. It just doesn't give you the context you need to make a good decision. The real question, the much smarter question, is simply, how big is the company? This tiny shift in your mindset from focusing on price to focusing on size is what really unlocks a much deeper understanding of any potential investment. And this is really what it's all about. It's about learning to invest beyond just the price tag. It's about looking at the fundamental size and the actual character of the business you're thinking about putting your money into. Because when you know a company's size, its market cap, you instantly get all this valuable context. It helps you set your expectations about its risk level, its real potential for growth, and its overall stability out there in the marketplace. Look, at the end of the day, market cap is a simple idea, but its power is just immense. Because in investing, your real advantage doesn't come from staring at the price tag. It comes from seeing and understanding the entire picture.